Try your dinner, Sunil.
He's a 1997 electronics from IITBHU. And he was in US for about 14 years, working with Verizon and few other companies. Decided to come back to India to pursue his passion. And he started this investment. We have a large group in India, mainly from IITBHU. And the place where he's staying, that's Shobha, it's called Shobha Portfolio. And all of us, those who have joined him, started following his advice, have been immensely benefited.
Sunil sir, you're frozen for a second, I guess.
Yeah.
Can you guys hear me?
Talk about my personal experience.
Yes.
Invested in stocks recommended by Anil, both in India and in US stock. And both of them in 1 year or one and a half years, they are up by an average of about 35-40%. That's the trend, both Indian and US stock. So the criteria that he decides, how to select a stock and all, gives you 10 stock, 7 of them will do very well, 3 may be down. It's very difficult to predict the market. So when you follow his advice, it's not that out of 5 he recommends you pick up only 1. Of course, he tells you the criteria, how you can select on your own. So over to you, Anil.
You're on mute, Anil.
Thank you, Sunil sir. Thank you so much for a lovely introduction. And I think we can start now. Is everyone okay? Can you guys see me and hear me?
Yeah.
And you guys can see my screen also, right?
Not right now.
Okay, let me just try sharing it once again. Can you see it right now?
Yes.
All right. So guys, this is the thing. Just 1 second. Yes. It is said that democracy is as good as the opposition we have. Similarly, and I made this up, this webinar is going to be as good as the participants we have. And that means, we all need to interact. And I want a lot of participation from you. Okay. So one thing, just 2 things, I guess. I will put all of you to mute. So whenever you have to speak, just unmute yourself and then put it to mute again. Second thing is that, you can turn on your video, because what happens subconsciously, that will allow you to focus more on this webinar and minimize other distractions. And that will help me also, just to see who I'm interacting with. Is everyone okay?
Yes.
All right.
Yeah.
Yes.
So here is a question, guys. How many of you are investing on your own?
Yes.
Few of you?
Yeah.
I'm doing so.
Okay, very good. So let me see. Okay, so very good. Let me ask you this. Let's go to the next slide. I'm just working out things here. Just 1 more second. How many of you have used any of these formulas in your investing journey?
Not at all.
Not at all, right?
I don't.
And I believe none of you. I guess some one hand is raised, but I think that will be an exception. But in general, not many of us use these formulas. These are academics formulas, so we are not going to use any of these. We will do investing pretty much without learning any of the formulas. Let me start with a quiz. And the quiz is, what are the 3 most dangerous addictions we have? Any guesses? 3 most dangerous addictions.
Investing. I think stock market.
Stock
No, I
market.
guess
That's a very good guess. Yes, but it doesn't need to be an addiction. To be honest, we can make it so that it's not an addiction anymore. Actually, anything
quick
else?
return, fear of missing out.
FOMO, yes, FOMO is there. Definitely. Anything else?
Drugs maybe. Sugar
Drugs,
reports.
yeah, very good. Why not? Drugs, is one of the big addiction. Anything else? Two more.
Winning money.
Winning money, yeah. I think we are getting close now. Yes.
Attachment to our stock picks.
I hope you are not pointing it to me, but
No.
perhaps, yeah, you can say that. We all are, getting biased at times. We have our biases for sure. We get anchored. I'll tell you first two, and I will let you guess the third one, guys. Okay. First one is drugs. Second is carbs, sugar. That is one of the biggest addiction nowadays. The
Alcohol.
third, anyone wants to guess the third one?
Gambling. Alcohol.
Alcohol, that comes perhaps, similar to drugs, maybe.
To earn more and more money after winning one stock.
I think that's a very good guess, Yes. Anything else?
Relation.
Lalach.
Love it. Awesome. Awesome. So let me tell you this one, guys. I think I can figure out a way to move these slides. Yes. Third addiction is comfort of monthly salary. It is said by Nassim Taleb, who's the author of The Black Swan. Comfort of monthly salary is very addictive. It makes you dependent on a steady paycheck. And that dependence on the regular monthly paychecks leads you to make bad financial choices and poor decisions. Is everyone okay?
Yeah.
In stock.
Hard hitting,
Yeah.
but
Yeah.
fine.
How can we answer because we are already addicted, right? So
Well,
But does
you
it fall
are correct.
under
You are correct. And that is the
definition of
thing.
addiction?
You are 100% correct. So the question is, how do we de-addict ourselves from this third most dangerous addiction? That is my next question.
The only way out is leaving that thing, leaving the addiction.
Yes.
Second source of income.
Learning how to invest is the best way to de-addict yourself from the third addiction. We have to learn how to invest. If we don't learn, we'll just keep on working till our 60s, 70s, 80s, and 90s for the monthly paycheck. Majority.
Create a parallel income.
Yes, create a parallel income, and investment will eventually lead to that, actually. That's correct. Now there is, so I hope, I have slightly convinced you that learning how to invest is important. And likely, we all are not fully convinced. So I want to ask you that there is always one more better reason to invest. Can you tell me what is like one more reason why we should be investing? I just found this.
To beat the inflation.
To beat inflation, yes, sure.
Tax planning.
Tax, yes.
To be
Independence.
Financial independence.
Yes, very, very good.
You enjoy this.
Yes, sir, sure.
You enjoy investing.
To get money work for you, something like that.
Yes, very, very good. And all of these are great answers, I guess. It's not fair to say
manage risk.
manage risk. Yeah. I think all of these are great answers. It's not fair to pick one. I will pick my one more reason to invest. And that one more reason is, guys, that no matter what, in very highly likelihood, in very normal circumstances, by following some simple discipline, and some of that, we're going to talk about today, we are going to grow our wealth 10 times in 10 years. That means that we are going to grow our wealth 100 times in 20 years. I don't want to go and think about how much we're going to grow in 30 years. That number is unfathomable.
1,000 times.
Now just imagine our kids are going to inherit that much wealth in 20 years from now. In 10 years, you get wealth for 10 times. So our kids are going to inherit such a huge amount of wealth that it is imperative for us to learn how to invest well and then teach our kids how to invest. So all of this, what I started doing and what I'm trying to do is just an effort in that direction to figure out a way to teach our kids how to invest. Is everyone okay so far?
Yep.
Yes.
All right.
No, we never teach them, rather they teach us.
That is correct, sir. But the thing is that they may think about that, but it is very important to learn the right way of investing.
Yeah.
And they may not know the right way of investing because they'll get influenced. And we're going to cover a portion of that today. So
they are more informed.
well, I think, we are going to talk about whether information is the right thing or not. And we will talk about that in just a few minutes. So question is, I hope by now we all are fully convinced that, we have our reasons that we should be investing, right? None of us should be having any doubts that we should not be investing. My question is, now we have clarified that we all need to invest. The question is, where should we invest? Any answers?
Depending on age, if he is old, FD or something. Depending on age, where should we invest?
Okay, so I have picked up some things. What I meant was, on what asset class do we think we should be investing? Is it real estate, gold, silver? I think we were talking about before this thing, crypto, bonds, stocks, treasury bills, cash. Where should we be investing?
Equities.
Mm-hmm.
I mean, a large portion should be in equity and then diversify in other
The
parts.
usual interpretation is that depends on your age and hence the risk appetite that you have. General
Yes.
perception is this. I'm not sure technically is it correct or not, but generally is depending on your age
So,
and your risk appetite.
so basically, the reason for diversifying is majorly because we are not much knowledgeable to take advantage of one good asset like equity.
So, guys, can I request to mute yourself, please, if you're not talking? I guess I just hear the background.
It should be a mix.
Thank
It should
you.
be something in equity, something in mutual funds.
Correct.
Very good. So let me come to the next slide and let me share what I'm going to say. This is the record. This is the chart for the last 200 years, guys. If the age is, we are not limited by the age, right? There is not even a question that we should be looking at anything else besides stocks. Assuming that, we all have, 10, 20, 30 years, there is, we should not be looking at investing in anything else, no matter what. This is the criteria which I believe we should follow. And a lot of us, many of us are very young here. So for everyone, I see people, who just graduated out of college and they are thinking about investing in gold and bonds and debt funds. And that is absurd. My rule is that unless you reach your FIRE number, that is where you can simply retire and not work, financial freedom number, you should not be thinking of investing anything else but stocks. Now, again, there are exceptions like, if one is, very old and, they require the dividend income and all that thing, there are exceptions. But in general, if someone, in like 20s and 30s and 40s and 50s, we all should be investing in stocks primarily. Only when, we reach that number where we can just, not worry about work and live off our investment income, that is when we should think about, buying some gold, buying some farmland, real estate, other things. But investing in other asset class before we reach that number is just handicapping ourselves. Any questions?
Do we have land or real estate in this?
It's not, we can put that, not a big deal at all. Nothing plays second fiddle to stocks. No other asset class. There may be cycles, where you can find some good thing, but it's not a repeatable process. Which is with stocks, it's a repeatable process where on a rolling 3 years basis, you can double your money.
Yeah, so I think for land, the CAGR will be around 6% in India.
There is no 6, 8%, 10%. It's
It's
not
less than stock only. It's
this
less than
thing.
stock.
Right.
So
What
Indian
I'm trying
stock
to
is around
say, even with lands and all those things, that is not a repeatable process which you can follow and which you can teach your kids that this is the land you should be looking, this is how you should be buying, and this is how you should be selling. So there should not be any question in anyone's mind that stocks is where you want to go. You have to pick other things only when you reach that fire number, or you need some income, some safety for variety of some other exceptional scenarios. So guys, two things have happened. We have discussed that we should be investing, and we should be investing in stocks. Now the question is, we have learned that we should be investing in stocks, but how to be a good investor? Because if we are not a good investor, we are going to fail, and we are going to fail hard. And because we are not a good investor, most of us, biologically or with our training and conditioning, we are not a very good investor, and hence we look for other asset class for safety reasons. But that safety is because of our conditioning and bad habits and wrong mindset, is because of that. So the question is how one can become a good investor. What are the traits of a good investor? Anyone?
Discipline.
Sure, very good. Yes, discipline. Anything else?
Fearless.
I'm sorry, what was that?
Fearless.
Fear?
Keeping aside the emotions.
Keeping aside
Like-
emotions. Yeah, sure.
Long-term
horizon.
Knowledge,
Yes.
I guess. Knowledge is very important, because why we are scared, why we, don't invest completely in equities, because of the less knowledge, and that gives us less confidence.
Okay, very good. Any other answers?
Only invest in stocks that you understand.
Okay, very good. So guys, I will tell you, there are three things actually, which I believe. Before today, I used to talk about only two things. The third thing I have added today only. And that third thing, the new thing which I have added, that will come the second part actually. So the very first thing is our behavior and psychology and mindset. We ought to have the right behavior and the right mindset of investing. And there are many examples. In fact, I have conducted a class, mindset class, which lasts for 2-3 hours. I have just picked one example from that. What I mean by that is, we have to change, simple things. We have to make simple tweaks in our habits and behavior. And that means changing from old habits to new one. Right? I'll give you an example what I mean by that. Let's take a look here. This is what most of us do. I'm sure there are exceptions, but primarily majority of everyone does this thing. We earn, we spend, and we invest. What's wrong with this picture?
It should be earn and then invest,
And then spend.
Yes, it's a simple thing, right? It's a very simple tweak, but majority of us do not do it. And that change just can take 10 years off from your working, age, basically. Just that simple change.
It is earn, spend, earn minus spend, invest.
You have to earn, from that you have to
Spend?
invest, and then remaining money you have to spend.
No, I think it is earn minus spend is equal to invest.
Well, that is what we all do. But we should be investing first before we think about spending.
Well, but you need something for your sustenance.
So this is the, obviously common sense thing. Sustenance, we have to, but it is about the, extra things which we spend. Going out and having a dinner 10 times in a month is not a good idea if we have not reached our financial freedom number. Having subscription to, Disney, Hotstar, and Netflix, and Amazon Prime videos, and 10 other things, are just not needed. Earn, invest, and then spend. So that is the very first thing. I believe it is very important. But there is a second thing which I'm going to talk about right now. I believe that is the most important thing. There is a third thing, which is about the financials we are going to talk about, and we are going to spend a lot of time over there. But that is the least important thing in order to become a great investor. First thing we are going to talk about now. Second thing is the behavioral and psychology and the mindset. And the third thing is knowing finances. Is everyone okay with that?
Yeah.
All right. So among all the three, this is the most second thing which we are going to talk now is the most important trait for a good investor. Unless we have this second trait, we are not going to become a great investor. So let's find it out. What is this, guys?
Lot of things in the mind. Or
Lot of options to choose from.
Brain fog.
Lot
Colorful
of
mind.
opportunities.
Creativity.
Anything
Colorful
else?
mind.
Free of fear.
Yeah, very good. I mean, these are good guesses. Guys, this
Confused
is...
mind. Confused.
Yeah, we can say
Confused
that.
mind.
This is information explosion. We are living in the age of information explosion. There is just too much information. My question is, can we quantify this information? Is there any way to figure it out how much of this extra information we are bombarded with right now? Any guesses? All right, I'll share it. Can you guys see this screen? On a daily basis, you all can see the screen, right?
Yes.
Okay. On a daily basis, we are being bombarded with 174 newspapers a day. In olden times, some 15, 20 years ago, it will take 15 years to read this many newspapers. And today, we are being served with this much information on a daily basis. My question to you guys is that this much information is there, who is consuming it and thus paying for it? Any guesses?
Common man.
Yes.
It's a waste of our time as well, and it confuses us. So we are paying for it. We are distracted.
Yes, paying for it. That's very true. Yes. And we can go. I think we all kind of know it's not a surprise. It's not it's a hidden secret. We are the ones paying for it. We are the ones consuming it, and we are the ones paying for it. We all will agree to that, right? My question is, how are we paying for this thing? What is the... Any guesses? Anyone?
By time.
Yeah, very good. By time, yes. Anything else?
Away from friends and family.
Away from friends and family, yeah, why not? Guys, the thing is that we are the ones consuming this information. We are paying it with our attention. Attention is the new currency, and most of us, almost all of us, are not using it judiciously. Right now, I'm trying to draw your attention, and I can bet that all of you are getting, all of you are getting distracted in different ways, right? From different things. So my question is, who is benefiting from all this? Information explosion has happened. We are paying for it from our attention, and who's benefiting? Any guesses?
Market, yes. Internet companies.
Anything
who are
else?
collecting the data.
Sure, yes, why not? Guys, remember, financials I can teach you in 6 hours. 6 hours I can teach everything about financial. It's not a big deal at all. And all of you are very, very good in maths. You all are going to pick it up. But that is the least important thing to become a very, very good investor. I believe this thing we are talking is perhaps the most important thing, which will decide whether we are going to become a good investor or not. So let's talk who's benefiting. These guys. We all know them, right? These are called attention merchants. They want our attention so that they make money. Any questions? We have similar merchants for stock investment too, right? We have seen CNBC, business news channels, NDTV profits, whatnot, MSNBC business, Fox business, Telegram groups, push notification, messages which we get all the time, Twitter, other bloggers, who are posting and distracting you all the time, sort of manipulating you in different ways. Do we know that $1 trillion economy is being built based on our attention? In this era of too much information, and when attention merchants, they're eyeing for our attention, the real question is that what is true wealth? What is that something which can give us an edge? Is it the information which we are being served with? We all have it. Is it the IQ? I believe all of us have the same IQ at a higher level, actually, higher than normal. Or is it our attention? Was it the true wealth which can give us an edge to become a better investor?
Control over our attention and emotions.
To control our attention, emotions, yes.
Decision-making ability.
Decision-making ability, okay, very good, yes. That's a very, very good guess, actually. Anything else? I think you answered it, so let's go to that. The true wealth which gives us an edge in this world, world where information explosion has happened and being bombarded by it. The true wealth is having mental clarity. When attention is up for grab and we are continuously manipulated by it, having a bit of mental clarity is a real edge. More so if we want to generate like a wealth through investing. What I mean by that? For example, like knowing the reasons why we have bought a certain company and then selling it for different reasons is not having a mental clarity. We buy it for a long-term basis and sell it because tomorrow price has fallen by 5%. Does it make sense? If you have bought a stock with a growth hook for 10 years, there is just no point in checking the stock price the very next day. Does it make sense, guys, or I'm confusing you?
No, it makes sense.
No, very right.
There is no point in checking your portfolio return on a daily basis. I have people, who ping me their portfolio return 2% a day, 3% a day. Little bit of maths will help them, or statistics. 3% a day means 1,000% in a year. That means they are not going to get 1,000. We all know that they will not get 1,000%. 3% today means 2.9% down tomorrow. It is absurd to take a look at the portfolio on a daily basis or watch a stock price go up and down on a daily basis. Your investment, and this is what I think, if you want to pick up one thing, this is what we all should remember. Your investment should allow all the free time you need and you want. They should not take away the little free time you have. Investing is really simple. It is so simple that most of us just cannot follow the basic discipline to invest well. Because in order to grow our wealth, that is really what we need. Very simple things. As an investor, having a mental clarity is your biggest asset. Unfortunately, we don't realize it. We believe that having too much information is the asset. It is not, because everyone has that information. People think that they have figured out a news on a Twitter that some promoter is buying and selling, so they also should sell. That information is worth nothing because it is available to everyone. So guys, we have talked about two different things: having the right behavior and the psychology and the mindset, and having a mental clarity about why we are buying, why we have bought this stock, and why we should sell it or when we should sell it. These two are the most important thing to become a good investor. Third thing, if you have it, good. If you do not have it, it's still fine. But third thing I can teach you. Third things we all can pick up very, very fast. Not a problem. And that is where we're going to spend another 30 minutes. And after that, I'll answer Q&A for as long as you want. What is that third thing? The third thing is, financials. So now we have learned, we have agreed that we should invest, and we should invest in stocks. We also have agreed that we have to work on two different things: behavior and mindset, and then having mental clarity. Now, the next question. Any questions? So the next question is, and we have agreed that we have to invest in stocks. The next question is, how do we decide, whether we should buy a company or not? Right? So I will just quickly go through it. Now, we have like two different ways to decide how we should invest. We have fundamental analysis, we have technical analysis. Can anyone tell the difference between these two things?
So fundamental goes with the numbers which the company project, like their balance sheet and profit and loss and all those things. So which goes every quarterly. Technical, it is kind of it gives you support and resistance. Basically, it gives you picture where when you can enter at specific price kind of thing.
So very good answer. I think I can just say it in a different way, that fundamental is driven by change in business. And the change in business we get to know only once every quarter. So if we make our decision based on business changes, then we don't need to take decisions, or we don't need to worry about making a decision every half an hour. Whereas technical analysis is based on the price, and price right now is changing pretty much every hour, every second, 23 hours a day. So if we follow the price movements, we will lose the mental clarity. We will get confused, and if we keep on watching those price charts, we will be forced to take decisions. We'll be manipulated to take decisions, actually. So technical analysis, we will leave it for now. In some other session, maybe I'll just cover it, how we should be using technical analysis. For now, we'll focus on fundamental analysis only. Now, fundamental analysis also has two parts, one is business analysis, second is the financials. And financials we are going to cover right now, actually. Is everyone okay so far?
Yes.
Yes.
Any questions? All right. So let me see. Can you guys see my screener right now?
Yes.
Okay. So let me just open this. I want to open a company. Let's say anything, Infosys. Can you guys see this thing actually? Can you guys see the Infosys chart here?
Not the chart, but the screener page.
Screener page. Yes, I'm sorry. Yes.
Yeah.
And let me log in with my other ID, I guess. That should be okay. So that we can see more numbers, I guess. Just give me 1 second. You can still see it, right?
Yes, yes.
Okay, very good. So guys, question is, this is the screener page. And in the end, I will share how and where we should be looking at the US stocks. The screener is a little bit more easier. So we will talk about it here and then see how we can, use the same knowledge, for US stocks. In a screener page, we can come here, we can query, and we can get the data for any company, all this data actually, right? We can see the ratios, the market cap, and everything. Then we have peer comparison with other companies. Then we have quarterly results, and then we have profit and loss. Then we have balance sheet and a few other details. We are not going to talk about any of those things. We are just going to focus on this part only, first half. My question to you all is, and since many of you are already investing, what are the important things, which you think, from this portion? What are the things which are important?
ROC.
ROC, yes. Anything else?
Stock P, PEG ratio.
PE is there and PG ratio is there. Yes. Anything else?
Debt to equity.
Very good. Debt to equity, yes.
Return on equity.
Return on equity, yes. Very good.
ROC.
ROC, yes. Fantastic. Let me ask you this. And these are very good answers. See, the thing is that, what is happening? Do you know here what is happening? We have information overload. We have just too much information. We don't need all these parameters. We just need like maybe 5 or 10 parameters, 8 parameters maximum, and everything else is worth ignoring. Knowing what to know and knowing what not to know, that can give you mental clarity and the edge. Let me ask you this. You all have given good answers. Some I may agree, some I may not, and we'll talk about it. My question is, if I were to ask you, what is the most important number over here? If I have to ask you to pick one thing which is most important, which can give you, what is the most important number which you think is here?
Market cap.
Market capital.
PEG ratio.
Yeah, I will say market
ROC.
cap. Market cap is just one of the most important thing, because just by looking at that, it can tell you whether you are going to have a multi-mega bagger or not. For example, the biggest company right now is HDFC Bank, roughly some 15 lakh crore rupees or something like that, 16 lakh crore. And the market cap of Infosys is 7 lakh crore already. So if we are investing in Infosys, thinking it is going to give us a multi-bagger in next 5 years, it is an impossible task. It just won't happen. Does it make sense?
Yes.
If we are going to invest in, let us say, Reliance, it is 17 lakh crore rupees company. Perhaps the second biggest one after SDFC right now. If we are investing in Reliance and hoping that if we held on to it for like 5 years, we are going to get 300% return, we are living in fool's paradise. It just won't happen. Whereas, we can take a look. Let's take a look at this example. KPIT, it's 38,000. In a normal scenario, it can grow and become 10 times in 10 years. That will still make it like a $300,000 company. Let's take another example. For example, from.
But how you know that 38,000 was built after 10 years, 2 years, 5 years, 20 years? How many years? What is the annual growth?
So, sir, that is, you can see it here. You can come here and see it. It's not a big deal at all. You can see how it is done.
So that is also very important.
Yes, and we will come to that. See, everything is important. All the information is given to you is important. The question is of the degree, right? If you start using all the information, it'll take, just remember, one day information which we are bombarded with, it takes 15 years to process. So we have to pick and choose. Only 5% of the information will give you 80% of your results. Market cap size is one of that 5%. So what I'm saying here, let's pick up another company, which I have picked maybe recently. Let's say this is small cap company, Arrow Green Tech, very small cap company, 1,000 crore. If we have to bet that whether Infosys will grow 2 times or Arrow Green Tech will grow 2 times, which one do you think will grow? Which one has a high likelihood, keeping other things aside?
Arrow Green Tech.
Yes. There is not even a doubt. 100 times of 100, you'll be right here. Looking at the market cap can immediately tell you whether you have a possibility of, multi-bagger or not. So if your portfolio is filled with, Reliance and Unilevers and Nestle and TCS, you are not going to go anywhere. Having that mental clarity gives you that extra edge which you need to grow your wealth 10 times in 10 years. Is everyone okay?
Yes.
Any questions, guys?
Not yet.
Okay, sure. My second, what is the second most, let's say, so we agree with the market cap. What is the second most important thing, basically? We also see, debt to equity, I think, PEG ratio. So I'm going to tell you this thing, guys. When you have to pick between the raw number versus the derived number, okay, always pick the raw number. That means that the number which are not derived, the moment the number gets derived, it becomes corrupted. It becomes polluted. It is not pure anymore. So for example, P ratio is the third order of derivation. Why it has some meaning, but that is not the number you should be focusing on. So from
ROC?
this, my favorite number is that ROC we should be focusing on, because ROC looks at the operating margin. It just tells you at the operating margin and how company is doing at the operating margin level based on the total capital employed. Without going into the details how ROC is calculated, ROC tells how efficient the company is. And before we go and talk about ROE and ROA, I say those numbers, we should just simply put aside and focus on market cap and then ROC. Because ROC tells how efficient the company is in generating the operating profit. Everything else can, be managed. If you don't have operating profit, then ROE and ROA number, are just being massaged, managed, manipulated. If you don't have a good ROC number, having a good ROE number, is meaningful in a leveraged thing, but it's not that meaningful. So second thing is ROC is very, very meaningful, and we can take a look. We should be investing in companies which have high ROC. For example, I can take a look. Let's take a look at this company, and I'm just guessing. I don't know. What is the ROC of this company? DLF. 5%. That means on all the capital employed, this company is going to make 5% return. How good do you think this company is?
It's not a good company.
Yes. Let's take a look at another company. For example, let's take a look as a large cap only, but that's fine. Let's take a look at Nestle. What is the ROC of this company?
170%.
Yes. That means if they're putting 100 rupees in a business, they are generating 170 rupees. If you have to pick two different companies, assuming everything else is same, which business you should be picking?
Higher ROC.
Yes. We get influenced picking big companies. Let's see what is the ROC of Reliance. 9%. They are going to give you 9% return. They themselves are generating 9% return. They cannot give you more than that. I mean, of course, there are other things, right? But we are ignoring all that. What is inflation in today's term? Real inflation. It is 10%. If you invest in Reliance, your purchasing power of the money, it will grow by 10%, but your inflation is also 10%. Your purchasing power is not going to grow at all. That means real inflation, we all know, is 10%. In some situations, it is more than 10%. That means you have to invest in companies which has high ROC. Investing in companies where, maybe big names, the names which we are talked on TV, those are, bad. Many of them are bad names. So if you're relying on the information which is being served to you free of cost, you will not be generating good returns. You have to look out for yourself. My number is, I look for ROC is greater than 30. Anything less than 30, I'm not interested at all. I just give it a pass. And I have queries. I have created some queries over here. For example, one can take a look. These are the fastest growing companies, and they have ROC 283, 37, 36, 33, 31. I do not look at companies which have less than 30 ROC. Because inflation by default is 10%. Till 10%, you're not getting anything. You will get anything only after that 10%, first 10%. Is everyone okay?
Yes.
Okay. So, come here. But I'll go back to the previous company we are looking at, actually, Reliance. What is the third most important thing? And I'm going to tell you right away. The third most important thing is debt to equity. We have to keep in mind that how much debt a company has. What do you think the debt of Adani's companies?
It's very high.
It's very high. And when debt is high, what happens? There is a risk.
There's a higher fear of default.
Yes. Right now, people can say government, if you are really big, government can give you a loan, and then you can default, and they can write it off, and you are free. You're scot-free. So what I'm saying, if a debt is less, you cannot go bankrupt. Companies go bankrupt only when they have debt which they cannot pay it back. Let's take a look at DLF. I do not know. I'm just coming. I cannot think of many examples right now. You guys have to come it up. Okay, so debt with DLF right now is not much, to be honest. It's very, very good. But again, its ROC is very, very bad. So why think about investing in this company? Let's take a look on the debt in the companies which I was looking here. You can see the debt which I'm looking at. 0, 0, 0, 0, 0, 0.1, 0.29, 0.03, 0.06, 0.06. These are the companies I'm interested in. Let's take a look. Any other names which you guys want think? I don't
Prudent.
know.
Prudent. Prudent.
Prudent is like a the banking and AMC company, but it has like a very less debt. Any other company which is a high debt? I'm trying to think.
Vedanta.
Yeah, Vedanta is like a their debt is 200% of their equity. I think they have simplified their debt. I suppose their debt was more. I guess I don't know. But we can take a look. Adani Greens is famous for it. Their debt is 6 times of their equity. That means their equity is 15 rupees, and they have taken a debt worth 90 rupees on top of that. If the business falls down by 15 rupees, they will go bankrupt. It won't happen, of course. But in a scenario where business equity falls down by 10%, they will file Chapter 11. Does it make sense? So guys, the three.
But sir, companies increase their debt to expedite sales. Like for this example here, Adani Green sales growth is 16%.
Sure.
Is that not a good indication?
No, see, it is an indication, but you have to think, you have to assume what you are not being told. What if sales growth reduces from 16% to 12%? Do they have money to pay back their EMIs in that scenario? What if that slowdown happens for 2 quarters? Do they have enough money to make payments for 2 quarters? What if besides that, there are some other issues, which can hurt their margins? And based on that, there's a number which I like. It is called the interest coverage ratio. It is called the interest ratio. That kind of tells that from their operating margins, how many years of EMI they can pay. So let us say the business completely stalls. This interest ratio tells for how many years of EMI they can pay. So right now, if Adani starts producing, Adani's business stops, they have enough money to pay the EMI for 1.39 years. What will happen after 1.39 years? They have to go to the banks and ask them to figure out something. That means that higher the interest coverage ratio, the better those companies are. Let's take a look again at the companies which I am looking at. I believe interest coverage ratio should be here, but maybe it is not, because that's fine. Let's take a look. Let's click here, network people. What is the interest coverage ratio for this company is? Can you guys?
3,300.
3,000. If they stop sales, if they stop making profit, they can make the payment for 3,000 years. What is the debt to equity here?
0.
What are the chances of them going bankrupt tomorrow?
Nil, almost nil.
Almost nil. Let's take another company, from here, and I'm going to pick up from here only. Let's say AstraZeneca. This is a bigger company, I guess, AstraZeneca. But we can take a look. Interest coverage is, this is 18,000 crores, so a little bit like a medium cap maybe. Interest coverage is 171. And what is the debt? 0.03. That means if we go and take a look at at the companies in our portfolio and figure out these things, we can immediately know how risky our portfolio is. So 4 things we have talked about: the market cap, the ROC. The lower the market cap, the better off the company is, the higher the chances of it growing many folds. The ROC, the higher the ROC, the better off it is. You definitely should go back and look at your portfolio and see what is the return on capital employed of those companies are. If it is less than 20 or 25, you must find out the reasons why you are having them. Now, I will tell you one thing. In US, this thing is not very common. So when I'm going to show you, one of the screener for US, I sent a mail to the CEO of that company to put this parameter in his screener actually. All right. Second thing is ROC. It has to be more than 20. I look for 30. Anything less than 30, I have to really find out the reasons that I should be investing in them. Third thing is debt to equity. It has to be very, very less. Anything less than 0.25, is the good thing. Anything more than 0.25, someone has to really force me and justify me that, why I should be looking into that idea. Does that make sense, guys?
Yep.
Okay. So, you know what? I will talk about 2 more parameters, maybe 3. And then I will open it up for questions, I guess. We are about to 1 hour, I guess. So let me talk about 2 more things. Market cap is there. ROC is there. Debt to equity is there. Interest coverage is there. That's a very good number. After that, in the beginning, at this level, if you don't know anything else, just ignore the PE ratio or the ROE ratio or the ROA ratio, basically. Okay. What we should be taking a look at, what is the this is the income statement actually. And these are the sales number, which is a revenue number actually. P/E ratio is derived from this number. These are the earning numbers. And P/E ratio is a price divided by this earning. So you can imagine from 198 to 4.78, how many iterations, how many manipulations have already happened. And if you are lying at this number, then you are not looking at the pure raw number. For us, the number at this level, I'm assuming that if you don't know anything much, you all should be looking at what rate your sales are growing. That's it. If your sales are growing very fast, then other things can be managed. Operating profit can become positive because you will have time to bring efficiency and scale it up. But if your revenue is not growing fast, then nothing else will happen. Nothing else will help. ROE number or ROA number or PE number, all that thing, will lead you to, face losses. So if you are looking at, any of these things, then we should be focusing on the sales number and we should be focusing on the operating profit number. As long as these two numbers are growing and the trend is going up, those are good companies. You do not want to have companies where the excuse me, where the sales is going down or the operating profit is going down. In fact, I look for acceleration in sales. I do not only want for the sales number to go up, but I want the sales to accelerate. And that is when I get interested. So I'm always looking for sales numbers to be going up, but the acceleration has to be there. So, all right, guys. From this thing, we should be looking at the sales number and the operating profit numbers. I'm just trying to think like what else we can tell you. In US, this number is very common, ROIC. Whenever we screen for US stocks, we will see the return over invested capital, which is a little bit different than the capital employed. I prefer the capital employed number. Another thing, percentage, pledged percentage this happens in India a lot, where promoters pledge their share to get money, to borrow money from banks. We just have to keep an eye that pledged percentage is not very high. That means promoters, they are not pledging their share to borrow money from the banks. Sometimes it can happen, but primarily we don't want this number to be very big. Like in the case of, I think someone said this company, Vedanta, I believe, we can see the pledged percentage is 100%. That means that all the shares promoters have, they have pledged these shares. In fact, I believe this was the case with Suzlon Energy also, but I think they have cleaned up their balance sheet and their pledged percentage is 0 right now. But some few quarters ago, it was very high. Any questions, guys?
No.
How
So
does
what
this
about
scale up to
changing?
mutual funds if we are considering mutual funds?
So, all right. So how about, I finish this part and then we can talk about, other asset classes. Is that okay? Arvind,
think-
just a minute or two, maybe?
I think current liability also should be looked into.
That's a very good point, sir. And, I have not covered. I think let's take a look at that also. I think that's a very, very good point. We can take a look at the balance sheet. And balance sheet is right here, basically. And what we should be looking at, these reserves, that reserves should be growing. This number, and we can see in Suzlon, why, share fell down. This number, was negative. The reserves is the total profit which a company is generating over time. And this is the borrowing. The thing is, sir, that borrowing is already covered in debt to equity part. So if the debt to equity is less, that means borrowing are going to be less. If you are looking for debt to equity less than 0.3, that means borrowing is going to be 30% only of the total equity. Does it make sense?
Yes.
How do we look at cash flows?
So, let's go here in the cash flow statement. Most of us should not get confused with looking at the net cash flow number. cash flow from operating activities is just good enough. And remember, cash flow comes into the too much information thing. As long as the revenues are growing and the operating profits are there consistently, that means cash flow is being generated. If cash flow is not being generated, company will face troubles in generating the revenue and maintaining the profit. When you are looking at these things, the simple thing is that you want to look at parameters which are meaningful and not the parameters which are talked on TV or which are talked by the experts to sound pedantic and intelligent. You want to look at the very raw number and not the derived number. Let your accountant look at the cash flow. But when you are making a decision, you should be looking at the revenue and the operating margin and the market cap and the ROC number and the debt to equity number and the pledge percentage and the interest coverage ratio. Once you have taken a look at these 8 numbers, everything else will start falling in the place. If cash flow is not there, operating profit will not happen next quarter. They're going to suffer. Does it make sense?
Yes.
All right. So, guys, we have taken 1 hour right now. How about this? I stop it and I will spend for as much time as you want, answering your questions. And then based on your interest, we can have this session, a follow-up session where we talk about this particular thing and spend more time and looking at these numbers actually. Is that okay?
Yeah, we need a follow-up session on it. Definitely.
Sure.
Sir,
And this,
one question.
you can share maybe in your feedback or something like that. And we definitely can do it anytime, whenever you guys want.
So where do we
Sir,
look at this?
are
Look
these
at
the
this in
same metrics that we look for US stocks as well?
So now I'm going to open the page first. I don't know what you guys follow, but I'll tell you what I follow. That is a simpler one. It is called stockanalysis.com, and I'm going to open that. It has a cleaner interface. That is all actually.
Can you please open for Boeing?
I'm going to open and tell me which company you are saying.
Boeing. BA.
Yes. Just give me 1 second. I have to log in with another ID, I guess, because I have. Just give me. Yeah, I think. Okay, let's open with Boeing only for now. Yes, tell me. Now.
Yeah.
Yes, tell me. So this is a very good interface, and I am acquainted with the CEO Chris Gunnars. So this interface over here does not have that ROC number. So I've sent a mail to him, and he has acknowledged that he will. Just 1 second, guys. And he has acknowledged that he is going to add the ROC number here. Let me just sign up. Give me 1 second. Let me log in with this ID. I believe I have subscription. Let me just. No. Forget. I'll take a look again. Yeah. So tell me, what do you want to see with Boeing?
So what is the prospect for this company share?
See, think about that. Can the demand for aeroplane grow exponentially in this year?
It is going.
I'm sorry?
Yeah, it is going because there is a big order backlog.
Yes. And think about that. What do you think how much debt to equity this company is going to have? What will happen if any supplier?
Maybe we look at what are the metrics we should look for the US stocks.
You should be looking exactly at the same metrics which I have talked in a few minutes ago, basically. No other metrics. Those are simple things which we should be following.
Okay, so where can we see the debt to equity and the interest coverage?
So we can come here basically. Now, if we see here, and we can see the earning per share is already negative. Let me see. Perhaps in the statistics, we can see a lot of numbers over here.
This is information overload.
That is correct. And you can see debt to equity is not here right now. It is not there. It is in the statistics page, but it is not mentioned for whatever reason. But you can come here in the financials and take a look at the balance sheet, and you can take a look how much debt they have here actually. And these are their total current liabilities, and these are their total liabilities. And if you see, their equities are already in negative. Net cash is in negative. Why do you want to invest in this company?
Looks like the website added ROCE also.
Oh, they did?
Yeah, under the statistics.
Oh, he sent me an email 2 days ago that he's going to add that. I asked him about the query section also, like screener, but he said that he won't be able to do it. But I'm going to keep on pushing it to him to add that basically. I don't know if ROC he has added, but that's great if he has done it. The CEO is Chris Gunnars, and he said that he will take care of it. But see, the thing is that guys, we have to take a look at this thing. Let's take a look at the income statement over here. Is revenue growing? So revenue is growing. How much it is growing? Do you think it's growing from in 2020? The revenue was $58,000 million. In 2024, it is $66,000 million. How much it has grown?
Declined.
How much it has grown?
10-15% hardly.
10-15% in how many years?
4 years.
4 years.
Why do you want to look into this company anymore? Let's take another company, for example. And I don't know how this company has done. FICO, for example. Fair Isaac Corporation. Let's take a look. Its revenue numbers: 12,000, 13,000, 13,000, 15,000, 1,700, 1,700. Much better growth, right? Let's take a look at the gross profit: 900, 900, 1,000, 1,200, 1,300, 1,300. A good trend which we want to see. I'll give you another company.
Take NVIDIA. Take NVIDIA.
Zscaler.
Which one?
NVIDIA.
NVIDIA, see, with NVIDIA, you should spend zero time in analyzing it. It is analyzed by pretty much everyone in the whole world. So its price is pretty much fair representation of everything in the market. Zscaler, and that's a good company because I own it actually.
Sir, I have a question with respect to the Boeing. You said like 4 years that has been negative. But what is the stock price? Because if you are spending money in the stock, the value there is the stock value basically as compared to the other things. If DE, debt to equity ratio, is low, that means the company is not growing because it is again value add for how much you are spending the money for your growth sector. So if you take like GE for sake of discussion or other consumer goods,
in such scenarios, we have to apply some, we have to think different. We have to think, and before looking at the numbers, we have to think it like this. Let us say if I ask Boeing to create 200 planes tomorrow, 200. If I give them the order of 200 planes, can they do it? They cannot. They will need to take more money, and perhaps build new plants for that. It'll take 5 years for them to come up with 200 extra plants, 200 extra planes, and they will need to borrow a lot of money. And then they are going to rely on at least 20,000 other vendors who will supply parts for that plane. In that next 3 years, their margins are going to fluctuate. Deal may get changed. Many things can happen. Boeing will definitely have to take too much extra money in order to furnish this order detail. Whereas, on the other hand, if you look at some companies like a CrowdStrike, which just provides software license for security. If you want 1 million licenses from them, they can give you in a week's time without incurring any cost from capex point of view. If you want to open, let's say, 100,000 people want to open an account in Robinhood. Robinhood can, handle that without requiring any extra capacity, pretty much zero capacity, zero changes, zero infrastructure needed for that.
I agree with you, because that is the same thing with like a Paytm or any company, because if they have to add a new merchant, that revenue goes up basically, but without doing anything.
Sir,
Zscaler is a good example. Zscaler is BHU.
Sir, Paytm makes zero money. They have never been profitable at all. You should
They
not.
don't have to be profitable, because if they are overfunded, like you are saying, debt to equity ratio, if the owner has pledged the share and everything to the bank or whatever, you understand.
Sir, too much information is just what I'm trying to say. You got to simplify. If you're looking at what you are saying is too much information. If the company is not profitable at some point of time, share will be valued as per the profits.
That is true. But then again, with the company kind of going, because how much competition they do they have?
Sir,
only they have competition with the Airbus. If you look at that level, so let us say some country needs some kind 200 planes. They cannot go in the world that Tom, Dick and Harry. They will either go to Airbus or come to this.
Sir, this is what I will say. If you want to invest, it's completely fine. In the end, you are responsible for your money.
Yes.
What I am telling you, that these are the parameters you should be looking. And if you're fine looking at the companies, it's completely fine. I mean, I will say, if you ask my recommendation, that do not invest in a heavy capex companies. Their return over capital employed will not be very good. If you need a lot of capex, that is a sign that you are not going to scale very well. Do not believe everything what is being taught in TV and newspapers and analysts. They are not on your side, to be honest. Only you are on your side.
No, very true. Yes, you are right.
So if someone says Boeing is a good company or Paytm is a good company, for what? They have made zero profit so far.
So, sir, coming back to Zscaler, the revenue growth seems good here.
100%. It is one of the companies which I own. And let's take where is the income? Yeah, just take a look over here. The revenue has gone up
you go
from
further, this is a BHU person basically, Mr. Chaudhary, I think. From,
yes.
Sir, you are 100% correct. I think his name is J. Chaudhary actually. And
yes.
You are 100% correct.
84, 85 batch, I don't know. Yeah.
Beautiful. Some of you, if you have a link, please figure it out, and we'll have a chat with him. We should be having a chat with him. It is one of the very good company. I own a decent percentage of it in my portfolio, not the company's share basically. But just see the growth over here from 431 millions to 2.2 billion dollars growth in the last 4 years, whereas Boeing went from 58 billion to 62 or 64 billion. Which company we should be investing in?
But their debt to equity is 0.87 and ROC is -6%.
Which one? Which companies?
Zscaler. If you look at in the statistics.
So okay. So this is the thing. That is correct. Zscaler has issues with the profitability yet, but when you are seeing the revenue numbers going this far, going like this, right, and their gross profit is increasing, right, and if you see their operating income, it has not grown in the same proportion as basically their operating income is reducing, and the losses are not increasing basically, right? So, and to be honest, the same thing is happening with Paytm also. Paytm has a similar number with some another problem, but the reason is that ROC is negative because their operating income is negative. But what we see that the growth possibility with Zscaler is very, very high, and with all this DeepSeek and all this coming into the picture, there are going to be more applications, and we will need more Zscaler security over there.
I think also Anil, I think if to your point, right, the revenue is growing, the gross profit is growing, but if you look and if you see the operating expenses, that decreasing. So that's all very good sign. The reason the operating income is very high is because of the accounting reasons, right? Like you're selling G&A, a lot of that goes into marketing expenses. R&D is all needs to be expensed on the same year. Whereas the way I think about these things is that I don't take that. I take the last 3 years of marketing expense and R&D for any IT company, and instead of expensing in the same year, you actually make it a 3-year pro rata. If you do that, then you will automatically start seeing that it's just an accounting profit, but you would start seeing that it's actually profitable company. So
100%. And remember,
yeah,
once they have gained one customer, next year for his earning, they don't need to go back and get him again. He's already there. That deal is sealed for, it's a recurring revenue. Their recurring revenue where is very, very high basically. So if you see their dollar-based earning revenue numbers, those numbers are very, very high basically. They're increasing 120% or 130% actually. I think someone is drawing some graffiti here. So what I'm saying, if we are looking at the earning numbers, obviously many things have happened in between, and we will get confused if we are looking at the PE number for a company like Zscaler or new SaaS companies basically. But looking at the revenue number and the gross profit number, and at best, if you want to go, this is the operating income. And sir very correctly mentioned this SGA number. We can capitalize it instead of expensing it. But you don't need to worry about it. Just the trend of revenue and the gross profit and operating income can give you a very, very good picture actually.
But operating
and
income is
also the
negative.
operating expense. Also the operating expense becoming negative, becoming decreasing function. Like the operating expense needs to be decreasing is a good sign. Like I'm not saying it has to be all the time, but it is being the fact that it went from 1900 to like 429, 430, and is always in that decreasing function is a very good sign.
Correct. And this is a little bit of complex company because a lot of growth is priced in. So the moment growth slows down, the share price, get affected. But the thing is that these companies, they have these companies are very scalable. They don't need to build anything extra for the new licenses. But R&D expenses are going to be there, and SGA expenses, are going to, come down over time. And with lot more applications coming in, there is going to be a huge demand for Zscaler and CrowdStrike and Datadog and their products basically.
Yeah, but their operating expenses are actually increasing, isn't it?
See, from 93 to 106.
No, operating expenses.
Oh, okay. So, as someone said, their SGA number has gone up pretty much in the same proportion, a little bit less, which is a good thing. Then the revenue, basically revenue growth. R&D number is huge over here, but eventually these numbers, will settle down. And remember what is happening with them. Every time they get a customer, that customer, the money which they spend in that, marketing expenses, that customer is going to give them a recurring revenue for next many years.
What this negative interest expense denotes? Interest expense negative means what?
Sir, this is the money they are paying for some loan basically.
But that should be positive. No? Expense should be positive. Why expense is being so negative? Similarly, operating income is negative, means not generating any income. Though the negative is loss is decreasing, but still there is operating income is negative.
So, sir, remember that every company has some nuances, and Zscaler falls. It's a SaaS-based company. it is not profitable yet, so it doesn't meet with that numbers of ROC and EPS and other issues. Unless you want to go in that detail, feel free to give a pass to this company. It's completely fine. And take a look at the companies where some, like let's say I believe FICO is very profitable, and let's take a look over here. Let's see their operating income from 300 to $733 million basically. Or let's say to this company, I believe this is also profitable. S&P Global, basically, we can say, they have doubled their revenue base in last 4 years, and their operating income is, positive. And you can take a look at these all the new SaaS-based companies. They are valued very, very highly, and they have some other things going on, which is not easy for an individual investor to kind of find it out unless you have some resource. And I will suggest you one thing, guys, for most of UK guys, if you don't have it, then any subscription from fool.com is very, very good. And basically, don't go for their portfolio managed services, but opt for something like their newsletters, and they have many newsletters. I believe Motley Fool has some UK based website portal also, and over there they may be having many monthly subscriptions. You all can that is a very reasonably priced, some $300-400 for the whole year, and you can opt for that subscription. And with that, what will happen? You will get 2 to 3 recommendations from them every month on a monthly basis.
Motley Fool.
Hi, Anil. I'm based in USA. This is a very, very good session. So thank you for taking time. Really enjoyed and learned a lot. You showed like 3 companies for US. Can you also show a couple of more companies and different nuances? Like what is the comparison or things we can see to make a good decision?
Sure. So, I will tell you this thing basically. For example, if you come to a stock analysis, they can look, they list, we can come here and, we can take a look. I'm just trying to see. Just give me 1 second. I'm just trying to find out if I can show you some good stocks. From here, I can take a look. Basically, I'm not able to log in with my ID right now, but they have a subscription where they show the top 50 stocks rated by the best analyst. That way, if you don't want to do anything yourself, you can come here and pick up the stocks which are rated strong by the best analyst, and then use the criteria which I have talked, some of those criterias, and see what matches, and you can just simply buy those things.
So, what about IPOs?
Sir, IPO investing, is like I don't recommend anyone to invest in IPO. Just, take time. Let the IPO perform in the public domain for 1 year or 2 years. If a company is great and if it is great means it is going to be there for 10 years, then even if you invest after 2 years, you still have ample runway left to invest in that company. So there is no, I have been investing for 20-25 years, and I have never tried to buy any IPO shares. And I don't think I have missed any returns at all.
But you invest less in IPO. Of course, the chances, risks are high, but as well as the gains are also very high.
Sir, again, why take the risk which I don't need? And I don't think, gains are very high. I am telling you that you will still make, 10 times returns in 10 years by investing very, very safely and without taking any risk in IPOs.
Okay, all such big ad comes for the IPOs these days, especially in India.
It's a free information, and it's a free information, and it is there to make you take some action.
Achha. And what about the technological disruptions? How do you account for purchase of stocks or IPOs even?
See, is it only your account? See, the thing is that let the company come in the market and show some profits, and then you buy the shares. You want to minimize, see, with stock investing, the upside is going to happen eventually because stocks go up. There's a 200 years of data, which, the chart which we have seen. Upside will happen without you doing anything. Only thing you have to do is not add a downside to your stocks.
Now, say example of DeepSeek, the stocks have fallen down of the other companies.
So see, what I'm saying, do not look at the price. Just because stock has fallen down, it doesn't make it a bad company. And just because stock has gone up, it doesn't make it a good company. The company becomes good or bad based on the earning numbers. That is all.
Okay. Okay. Thank you, Mr. Anil. Yeah.
Yeah, Mr. Anil, can you please tell those criteria once again?
And who is this? I'm sorry, can you please put yourself on mute, sir, if someone is not talking? Thank you. I'm sorry, go ahead now. I'm sorry.
Yeah, no, I was asking if you can tell those criteria once again. That will be good.
So criteria, I will share this recording with everybody so we can see that. But the criteria, what we should be looking is that company should have a smaller market cap. That's a better company, right? Company should have very high return on the capital employed or return on invested capital. Company should have very less debt. Company should have growing revenue, especially accelerating if that is possible. Company should have gross profit and operating profit. And do not worry about cash flow and all that thing. Those are like a shenanigans happens, and you are not going to figure it out basically. If you're asking to so just ignore that thing basically, and see the trend. The revenue should be growing, the gross profit should be growing, and the operating profit should be growing. If EPS is growing, that's a good thing. And if the numbers are growing and stock price is fallen down, just go ahead, you can buy a small position in that stock. For example, I will, okay, yeah.
Yeah, that's fine. Thank you.
Anil, sorry.
I'm sorry,
I have one more question. So when you have a portfolio, generally, what is your recommendation about how many stocks you should have and how should you rotate it to maximize?
So two things basically. I believe that academics can say anything. Practical learning and practical managing a portfolio is much, much different. If you own 20 companies versus if you own 50 companies, pretty much returns will not vary too much. As long as your 80% of the money should be in 10, 12, 15 stocks. That is what you need to see. So in the beginning, I advise everybody, I'm sharing, I have a public portfolio in India, which I'm sharing with everybody. In the beginning, I want people to build positions over time. Do not buy 5% in any stock at any point, no matter what. No matter how good the tip is or how good the recommendation is. Always build it slowly. Start with 2% if you are comfortable. If you are not, it's completely fine to have a 1% position and then have 1% 3 months down the road. So that way, you can take 3% position in a stock and you will eventually have 30 to 35 stocks. That is a good enough diversification for you basically.
Thank you.
Does it make sense?
Yeah, it does. Thank you very much. My other question is, how do you get out? How do you exit? Like, how do we know when to exit? So, this is a question which is not very easily answered. But for me, let us say the revenue growth has started slowing down. Okay. And we don't have a very good reason. Let us say Tesla's revenue has slowed down right now, but we know that it'll pick it up again in 2026 and 2027, and it'll start giving up like very good operating profit. So there is no reason to sell Tesla, for example. Okay, don't follow my advice on Tesla right now, but I'm just giving you an example. But if there is a company, for example, Boeing, or any other company, let's say, we can pick where Nike, for example, right? We know Nike is struggling. Can they go back to their, previous highs? Can they, now with a lot of competition with Onan and other things actually, can they gain their market share? If they have started to lose market share, and we don't understand the reason and we believe they're not going to get it back, that is time to get, to sell that stock and move on. So our decision should be based on the business and not on the price. That is a time when revenue has started falling down, and we know it is not a cyclical thing, and we feel it is not going to come back. That is when we should just completely sell and get out. What I want for folks in US, because that is how I started, is that you can take that $200 subscription, $200 per year subscription from motleyfool.com,
and they do a very, very good job. Their recommendations are okay, right? I mean, they are not like exceptionally well, but you're going to learn a lot from their subscriptions, and you're going to get many ideas, 20, 30 ideas every year from them, and you keep on investing a small money in them. So every month you'll get like a 2 to 5 ideas, 2 recommendations, and then 3 or 5 some other best buys. You start putting some money in smaller amounts in those companies. And eventually what will happen, you will have a portfolio of 30, 40 very good stocks. Some of them will fail because those are small caps, maybe some of them, but some of them will do very, very good. And they will propel the whole portfolio basically.
Thank you. That
Sure,
was,
you are welcome. But
Sir, can we
that
look
was
at
very
a couple more stocks from different industry?
I'm sorry?
Can we look at a couple more stocks with different industry?
Please do, please tell
Let's
me.
say Walmart or a Target.
Yes, so now, think about it with Walmart, for example. If we logically think ourselves, right, it requires a lot of capex. If Walmart has to open one more store, we know that they have to spend lot more money, right? And then they have to deal with, suppliers are there, then vendors are there, then returns are there, then thefts are there, then there is operating expenses, of running the Walmart store, right? Logically, its margins are not going to be very good, right? So we know that if we invest in Walmart, its margins are going to be very thin, 3, 4, 5, 6, 7%, not more than that. And then there is like a lot of competition. Amazon is there on top of that. In India, it's Amazon Fresh, something like that over there too. So when you are investing in companies like Walmart, you got to think it intuitively whether that company can scale, many folds.
What about Meta?
See, Meta is a great company, can like, I mean, companies like Meta or Google or Microsoft, like a Microsoft has fallen recently yesterday or something. So that is a time we know that Microsoft will be there 10 years down the road, no matter what anyone says. So it is completely fine to invest 0.5% of your portfolio and buy a few shares of Microsoft yesterday. Don't buy 5%, right? You want to, average out over time. But when these Mac 7 companies, anything, Meta, Google, Netflix, any of these companies, Tesla, Amazon, when they fall, just go ahead and buy 2 shares, 4 shares, 5 shares. It's completely fine. These companies have defied the market cap criteria and there is no end to it. So, we all should be having some stake in these companies. And as price falls, for no justifiable reasons or for macroeconomic factors, just go ahead and buy, some few stocks, a very small position, add it to your portfolio. What I want everyone to kind of follow, that don't try to, be rich tomorrow. That is when the problem happens. Try to build your position over time slowly. Take a small steps. Buy 10 shares of Amazon or Microsoft, for example. And if, price falls again, let us say 10% more, then next quarter, buy 10 more shares. So the process of nibbling in and nibbling out is the best thing. So when someone was, ma'am was asking about exiting, we don't need to exit out immediately, because great companies with the very less debt don't fall apart immediately. It takes like a very long time for them to die down. So over time, when you see that the revenue is not growing, profits are not growing, start selling some portion of it. If you have Nike, then definitely start selling some portion of it. If it's Starbucks you have, I don't know, maybe Starbucks has gone up recently, just sell some stocks, because it's going to fall back to 80 or 90 again. That is when you can buy it again.
Do you have similar recommendations subscriptions kind of thing like in India? Where do we follow?
No, India, to be honest, there is nothing like a Fool.com. I believe Fool.com is one of the best recommendation service at a very, very cheap price. And for people in US and in UK, I believe instead of figuring it out, because see what is happening in US, there is no good system as a screener actually, right? Hence, numbers are a little bit harder. Stock analysis is still better. There are other websites, but they all have some issues basically. On your own, figuring out all the information is a little bit harder. But whenever you're buying some company, let us say Motley Fool is recommending something, you can take a look at the market cap. You can take a look how much debt they have. You can take a look how much sales growth is there, how much gross profit and operating profit is there, and that can give you some idea how good this company is going to be. Because if sales growth is growing is 10% and then 8% and 7%, then eventually it's going to happen 6% also. That is not a good trend. So just don't buy in that company or buy a smaller amount till you see the turnaround happening. I think your question was, are there any other things in India? Is that what your question was?
Yeah. Yes.
So in India, I don't think anything is worth subscribing to be honest.
Yeah.
In India, you can follow what I'm saying, because with the help of a screener, the experts and the amateur like us are at the same level because of a screener. Sadly, in US, there is nothing like that, nothing as good. And Chris Kunars, this stock analysis CEO, I'm going to keep on pushing it to him, and he may eventually do it. But it can take 6 months to 1 year or 2 years, maybe something like that, to build up something like as good as a screener. So for US and UK folks, you have Fool.com. Use that. I am one of the biggest beneficiary. I started subscribing to their services in 2000. Right now, I don't subscribe, but I have other things going on. But I think that is one of the best thing at the very cheap price, which everyone should, even if you're not investing, you can subscribe to that and learn from it.
Thanks for introducing to Screener. It's really a great website. Can you share your query on Screener? We will like to also use the same query.
Yes, and definitely. My queries are there, and I guess there are 50 other versions if you search with this thing of my queries. So you ping a message, and someone in the chat will give you these queries actually. Or if you search with my name, you can find or ping it in the chat, and someone will share it for sure.
Sir, on the point of queries, is it possible to build queries in the stock analyst website for US?
Sadly, no. Stock analysis, has that limit, and Chris Gunnar told me that he won't be able to do it. But again, I'll just keep on pushing. I mentioned it to him. If you're not going to do it, someone else will, and you will lose one of the best thing, which you can do it.
Maybe someone from this group.
I'm sorry.
Maybe someone from this group can
Why
build
not?
such a
Why not? I don't have bandwidth, and I don't have an interest in that part. Otherwise, that is definitely a good idea for any of you guys. And Neera, ma'am, I think you were raising your hand, please.
Yeah, Anil, another question. Regarding technical analysis, which is based on price, and there's a lot of time wasted, like every day you check and you make a decision or you get tense. What do you think about it? Like in the beginning, you mentioned, you'll cover that a little bit, but focus should be on fundamentals. So what are your 2 cents on that?
See, I believe that the most of the money you are going to make eventually, that will be from holding great businesses and holding them for a long time. However, there are ways, where you can generate, some money by trading in and out. You have to follow certain rules. For example, here is something I can tell maybe. All right. So I don't know how much, for example, people know technical analysis, but nothing works more than 50 to 53%. Nothing works 75 or 80%. No other indicator in technical analysis, or no support or resistance or demand or supply, no other price indicators will work accurately. So you have to remember everything, which is there. It works 50 to 55%. Sometimes it works, sometimes it doesn't work. The problem is when you are using technicals without knowing the fundamentals, you may run into issues where you end up holding a company which is not very good fundamentally. Second thing is that if you know some technicals and you want to use technicals, then my suggestion is that use it only on NASDAQ 100 companies. Why? Because those are the best companies. Those companies are growing very fast. They don't have a liquidity problem, and those companies are more likely to bounce back. So if you end up holding a company which has gone down, let's say Microsoft has gone down, right? So it's still fine. It's not a bad thing, right? You can put more money maybe, and Microsoft is more likely to bounce back. So if you want to use technicals, you can use technicals, but don't use on the IPO stocks or on random stocks, which you have heard, or those penny stocks. Use it on NASDAQ 100 stocks. And you'll be fine. Pick any indicator. Just remember that nothing works more than 55%. Everything.
What does it mean? Nothing works more than 55%.
Because if someone is saying that this here the volume is there and the price has gone off, it doesn't mean price will go up continuously. It can still fall, right? If any indicator is showing that the Bollinger Band is there and stock has broken the Bollinger Band, that does not. It can still fall down, or it is breaking the upper level. That doesn't mean it will keep on going up. It can still come back.
Okay.
So, excuse me, I'm sorry. So technical analysis works. And maybe at some point of time, we can conduct a session where I can just teach you simple strategies which you can follow. But whenever I teach technical, I tell them not to use on every stock. Every stock is not meant for technicals. See, small caps, companies you want to identify and hold them for a very, very long time. It's, for example, let us say someone found Chipotle in 2005 and he sold it in 2006 because the price moved up 100%. And he never got to buy it again. That is the biggest loss he will ever see in his lifetime. He has lost a fortune because he tried to take that 20-30% profit basically.
Got it.
So do not use technicals on a small cap where your odds of getting high are multifolds. Use technicals only on NASDAQ 100 stocks, which has high liquidity and they have a very high chance of bouncing it back. And none of them are going to grow 100 times or 10 times in 10 years. That won't happen. With Tesla or something, it can happen. But on an average, they are, they have big market cap.
Great answer. Thank you.
Welcome.
I know it's very late. Bhaiya, just one question here.
Anil sir, in US, a good portion of our income is in 401k, and there you don't get option to buy individual stocks. It's usually mutual funds and with very few options.
Yes.
Like those target retirement funds, and sometimes there is S&P 500. What's your advice for that?
So I am an expert in sorting out that process in 2004 because my portfolio was with Verizon stocks and Verizon stocks fell down. And I did not cover that part of my presentation today, but maybe some other time. My $75,000 401k became $28,000 and I panicked. I did not know what to do. So I started learning out, how 401k works. And that is when in 2005 or 6, I figured it out that there is something called non-hardship withdrawal. Okay. Every company has it. The process is hidden and it's a guarded secret. But if you prod them enough, they will tell you that there is a non-hardship withdrawal from your 401k and there's a limit to it. That means, you cannot take it like 100%, but 30, 40, 50, 60% of the 401k portfolio, you can move it to your rollover IRA account. And in rollover IRA account, you can buy anything you want, just like your Roth IRA.
But sir, with getting the money out of 401k is again a science basically.
Sir, what I'm telling you,
they will lend you money for a certain period of time. You have to keep track of it. So it is, at least I will not advise somebody to take money out of 401k and invest somewhere else.
All right. So
rather than, like you are saying, if you have a trick. Yeah.
Sir, let me tell you one thing. When you move money from your 401k to rollover IRA, that is still an IRA. There are no tax consequences. You do not pay any penalties. You have an exposure to invest that money just like your Roth IRA. All of my portfolio.
I'm sorry to interrupt you. If you are moving the money to Roth or whatever, you have to move all the money in my mind. So for 401k, you have to have a reason to move the money to Roth. Either your company change or you have to change the account. In that scenario, rather than investing into the new company 401k,
Sir,
you
listen
can
to me.
invest in Roth or something. Anyway.
Sir, listen to me. I have done it in 2006. I have done it with my another company in 2008. And what happens? A portion of your 401k, which is called non-hardship withdrawal, that you can move from your 401k and move it to your rollover IRA account. I have all of my 401k before even I left my company. Most of it went into the rollover IRA account. Now, I don't want you to take my words, but at least do some investigation. Don't allow your conditioning and your existing knowledge, because I have done it. And many of my friends in my company have done it. This process is there. It is a obscure process. It is not known to, you are already an expert, I believe. But even no one knows about non-hardship withdrawal. And that process, you can move money from your 401k to rollover IRA and invest in stocks and invest in options.
So what is the term you're saying? Non-hardship withdrawal.
Yes, sir.
Because I have a meeting today with this
yes, sir.
reality
You should.
company,
You must
and I
inquire.
will ask.
You must inquire and find out. You have to find out with your advisor and discuss. The pros and cons. And every company has it.
And Anil Saab, you are very passionate, because I can say that in 15 minutes of attending this meeting, very passionate, whatever you are doing. So thank you very much.
Oh, thank you, sir. Thank you. I'm glad you all are still here and listening, and hopefully, you find it valuable in some way.
Yeah.
Sir, for the non-hardship withdrawal, are there any taxation?
Non-hardship withdrawal, which goes to the rollover IRA account, has no taxation. Only you cannot withdraw all the amount. Every month or every year, you can withdraw a portion of your 401k. No one knew this process, not even my American friends. I figured it out when my portfolio in Verizon crashed in 2004.
Anil Saab, I will ask this
And
question
after that,
today and update you in that.
after
group.
that, I have done it in Verizon. And while I was, and you can do that while being in the job in that company. I did it in DTCC, and many of my friends in my, these companies, they have done it basically. And you get exposure to all the stocks. And I love options, so I can do options also. Right now, I don't have a 401k account. All of my money is in the rollover IRA account and Roth IRA account and taxable account.
And sir, the portion that's left in the traditional.
I'm sorry. I'm sorry. Your voice got cut off, I think. Any other questions, guys? I'm sorry. I think someone was saying, but I think he got cut off.
Anil, I have one more question.
Please, sir.
With the stock, if you have to add options, because unless you do the option game, stock has, I don't know, I don't want to say anything. But
sir,
will you take another session with options and related to 401k class? I would like to attend that. Basically.
401k, I don't know. I mean, whatever I know, I told you actually. Tax and 401k, I mean, I leave it to my tax guys actually. I don't. I'm just telling you the process, how I was able to withdraw money from 401k and moved it to the rollover account. That is how I was able to invest in great companies and double and quadruple and grow my portfolio many folds actually. While being on the job.
Other thing is, how do you put options into a stock buying? Basically, you have to take another class.
Sir, yeah, sure. At some point of time, maybe I'll think about it. Option is a great thing. I do a lot of options in US, and I don't trade. I do not trade. Like right now, I don't know. I don't check options every day. As I said in the first part of the class, that your investments should allow you to free your time. They should not be there to take your free time. So that is how I invest in options also. I check them once in a while, and they are the great way, especially in US, to invest properly.
And sir,
but you have to take a class so that we know the basics. Basically, I'm sorry to interrupt. I will put myself in mute.
Sure. I mean, give it in your feedback, I guess, to Sunil sir, and send a mail or something, and we can think about it. Actually, definitely.
Yeah. And sir, the money that's left in the traditional 401k after the non-hardship withdrawal, where you have very few options.
Sir, I mean, You cannot have everything. I'm just telling you, you cannot do anything with that. You have to live with it. Once you leave the company, then you can move that part of remaining money to your rollover IRA again. Never leave any 401k with the company. When you leave the company, always move the remaining part to your rollover
You didn't
IRA.
convey that to me.
There's no
Yeah.
information anyway.
For
Then
that
why
is
don't you communicate?
a good option.
The profile is on it.
Guys, if you're not talking, can you please put yourself to mute, please?
Anil, what is your view on oil stocks and secondly on the Indian stock market?
Sir, Indian stock market, I have a WhatsApp group. I have 1,500 people over there. I share it all the time. But see, I look on a scalable business. Oil things are very costly. They are not scalable. They are dependent on too many other external factors. And if you have to buy a new rig or something like that, it's just very costly. I mean, everything is very costly. Price is driven by the international market. Why should I invest in oil stocks? It doesn't make any sense to me. I like very asset-light businesses where return on capital employed is very, very high. Oil stocks, steel stocks, these big Walmart and Target and Macy's, they cannot do that.
Thanks.
Where can we see geo financials for just a sec? Because whatever you have mentioned, the parameters. So this is one company which is kind of little bit, falls in a different criteria. So I just want to understand what makes you, just is it the growth option for geo financials?
See, how about just trusting Mukesh Ambani? I mean, he has the best advisor. There is like a lot of optionality with Geo. I just my thing is that there are two things. Geo Financial is not properly valued based on book value basis. That's how I see it should be getting valued. They have 6% shares of Reliance. They are down because Reliance is down right now, and they have a lot of optionalities. What they will end up doing is something for all of us to see. It is not about a stock which we should be judging based on what is happening in this quarter or next quarter. I am just trusting, these are the richest guys and they have the best team, and there are like a lot of options for them to go into. So I'm buying this stock for 10-year growth story, and we will see how it unfolds.
Okay.
Anil sir, how to know whether a stock is fairly priced or undervalued or overvalued?
I will tell you this thing. The real answer is that even Ashwath Damodaran sir will not know. That's a correct answer. No one knows. What we know is, you can do, we can make guesses, guesstimates, we can do relative valuations, but no one knows the fair price. You have to assume that the NASDAQ 100 companies on that day basis, based on the information on that day, these are fairly priced. You have to see what happens that when there is some negativity, stock takes the extreme pessimism position basically, right? People become extremely pessimistic. That is when this mental clarity comes into the picture. Microsoft has fallen down 5% because of earning report. I haven't seen earning report, and I don't need to see to imagine that Microsoft will become $450 and $500 in next 1 year very easily. And it doesn't need to know and read. It is a common sense thing. Companies like that, which are going to be there 10 years down the road, and which are very profitable. They have some stake in OpenAI and all that thing. When they fall down, you just go ahead and buy it. Instead of buying like oil companies or Boeing companies or Target and Dillard's and Macy's and these type of things, clothing store, buy these companies where scalability is there, operating efficiency is very, very high, and that it's very hard to displace them in next five years or so.
Perfect.
So real values, no one knows. Ashwath Damodaran gets it wrong 50% of the time. So who are we? We just have to make educated guess that when there is extreme pessimism built in the stock price, we have to think it differently and see that Can this stock not go? Remember, Chipotle has gone down so many times with the E. coli and all that thing. We just have to think it a little bit ahead and see that can it bounce back? If it can bounce back, then just buy that stock, because stock price will start showing the results 6 months prior to the actual result. I'm sorry, my throat is just. Yes. Any other questions, guys?
Yeah, for US stocks, how much market cap should we look around? How many $1 billion is like?
See, I look for, there is a, I either invest in a NASDAQ 100 stocks, right? You take a look at NASDAQ 100, there you can, like Neera ma'am was asking earlier, we can do trading, you can take technicals and you can use that, you can use options. Or I look for companies which are like less than, $5 billion actually. Or 2 billion.
Oh, and is S&P 500 a good investment?
See, I mean, you mean stocks in S&P 500? That's what you were saying?
Yeah, the mutual fund. Yeah.
Yeah, I mean, why not? See, it's very hard for me to. I mean, they are not bad investment. Let's say it that way. But if you don't know anything, put money in index funds, put money in mutual funds, and then if you're starting from scratch, then start putting money in these, Max 7 stocks, and then start putting money in NASDAQ 20 stocks, NASDAQ 50 stocks. Like ASML, that company which makes the lithography machines, it has fallen down recently, right? But data centers chips cannot be built without the machines. So that price has some extreme pessimism built in, whereas there is no competition. People need to buy those machines in order to build chips. You can, when there is extreme pessimism built, you just show some mental courage and some mental clarity and you buy those stocks.
And you said to subscribe for fool.com, their subscription. But let's say if they recommend a stock every month, so then do we change like our pick, or how much
These are like general questions. See, the thing is that it's completely fine if you have a 50 stocks or 100 stocks. It's completely fine. Don't panic and don't think about whether they'll give you a decent return. What will happen once you have a 50 stocks, that only 10 of them will grow big and they will become a bigger percentage. You want to fuel those 10 stocks and ignore the ones which have gone down and cut in half. So let us say you built a portfolio of 50 stocks, 10 of them are performing. So your laser sharp focus should be on those 10 stocks, finding an opportunity where you can add on to those positions and focus it there. They will make the remaining 40 irrelevant. You don't need to do anything. Does it make sense?
Yeah, makes sense.
So we should not be worrying about those things. Just keep on buying good stocks, and eventually some stocks will become so big that they'll become large portion of your portfolio, and that is what you want. Thank you, Neera ma'am. Thank you. I saw your message just now. Yes. Anything else, guys? We have finished 2 hours, so I can take a few more questions if you have it. But please give your feedback to Sunil sir, or like when you get the email, and that way we all will know, should we do it more or should we do it less, or should we do it differently, or what topics you're interested in.
So I guess we should keep an eye on the promoter holding as well.
100%, yes. I think we missed it, but that is a very good point. And yes, we should be keep, along with the plus percentage, we should be keeping an eye on promoters holding too. The higher the promoter holding, that's a good thing, especially if they are buying stocks.
So do we refresh the portfolio after getting quarterly results, and do we track, do you track with the calendar that, okay, what are the portfolio companies, when are they getting their results out, and then you refresh things?
See, the thing is that, I buy companies, not like, my thing is that I don't act the day results have come. I act in the next 3 months after the result. So whenever I find time, I will take a look at the results, and then I'll decide, what I want to do, whether I want to add to it or whether I want to reduce my positions. The companies I own, those companies I'm owning with a long-term mindset. So I'm not looking for getting out, no matter how bad the quarter results are. I'm not going to get out of that position in this immediately. It'll take 1 year for me to get out from that position. So, and that will happen slowly if the numbers are not good or not that I expect. So I don't see, or track. I don't want my investment to force me to take any decisions. I take decisions at my own convenience, and it does not matter what market is 5% up or 2% down. On an average, I am fine all the time, basically.
Anil, can you circulate your feedback or response form? Send it to me, that I will circulate in the group.
Sir, 100%. I think we must do it. I will create a survey on Zoom only, and I can send that to you. Is that okay? And then we can,
Okay. Yeah, that's fine. Yeah.
We'll do that, sir. Tomorrow I'll do that, and then we can send it.
Yeah.
Any other questions, guys?
I think it's more than 2 hours, 2 hours and 6-7 minutes. So thanks a lot, Anil. Thanks for conducting this session. I'm sure it was quite valuable to all the participants. On the chat box, I saw several feedbacks thanking you for the session. And they are looking for more such sessions in future. Especially on options, there are some requests on options. So thank you, Anil. And
thank you. Thanks to you, Sunil sir, and thanks to everyone for attending this session so late and so early over there or different time zones. But thank you all for participating, and I hope you found it, beneficial in some way. And we can do more if you like it, basically.
Yeah, 100%, sir. Every
Thank
time
you
you do
very
these,
much.
I'd love to jump in.
Thank you so much.
Thanks.
Thank you
sir.
all, and good night. Thanks a lot.
Thanks, Sunil, as well, for organizing it.
Thank you, sir.